Hey everyone, welcome back to another edition of Super Prime UK with your Super Prime valuation specialist, myself, Rob Cohen.
Myself, James Wild.
It's been another super active week in the market. So much happening, so much activity. It's just moving so quickly, which is what I love mostly about doing the show and the weekly update is from one week to the next. There's so much information and intel to share with you and so much to update. And that's what James and I are here for. So let's go straight to it, James. Let's share with everyone what's been happening.
Thanks, Rob. So in terms of the data for this week, we've got 349 new instructions, just above the average for the year, Rob. So I think that's very encouraging. And like we said, we've now moved onto a 5-day week for the data after the May Day bank holiday. So I think that's reflected in the data as of today. So 349 new instructions this week and 143 sales, just above the average for the year, which is again very positive there. Under offers remain strong, Rob, 224 for this week. So again, that pipeline remains, and in terms of it feeding through to the sales transactions, which we're seeing in the data. As we said the last 2 weeks, we have experienced a little bit of market cooling, but the market is remaining very resilient within this time of economic pressures.
To go into more detail on that one, James, I've been spending a lot of time with the agents because we really want to have our finger on the pulse and share with you what's going on. And although the numbers are strong and robust, the reality is in the locations where you had 40 buyers and maybe 5 or 6 offers, now maybe you've got 25 buyers and 2 or 3 offers. And the locations where you had maybe 20 buyers and 2 or 3 offers, now maybe only 10 buyers and 1 or 2 offers. So there's still enough demand for the lack of supply and shortage in the market for there to be, like James has just reported, strong under offers and a large volume of new instructions. At the same time, it's not the same levels as there was at the beginning of the year and the back end of last year. I think that's the key change for all of you out there listening. Strong data, yes, but the true reality of what sits underneath that data is a changing of the market conditions.
Yeah, thanks, Rob. Just in terms of a bit of news in terms of the sale of the week, quite interesting, Rob. It was actually a flat this week rather than the house, with the main drive being towards their house market. Flat on the Bishop's Avenue for just under 8 million in the sort of prime section of that road, just next to the sort of Bucksmead development there, very famous flatted development. Yep,
historically, Bishop's Avenue, the premium road in arguably in London, with a lot of prestige, and maybe today in 2022, that arguably has been taken over by Avenue Road. It's all subjective, where we've seen some very high-end, lucrative super prime transactions.
Yeah. Thanks, Rob. And just in terms of the economy and fiscal data for this week, obviously, we've got the inflation data later on today. That's expected to hit around 9%, so just creeping towards that 10% mark. Again, slightly concerning. I know the Bank of England, with its 4 interest rate rises, is trying to get that under control. However, new data on the job market, there's actually more job vacancies than unemployed people in the UK for the first time ever since records began. This is as unemployment fell to 3.7% between January and March earlier this year, which is positive for the economy, Rob. That's its lowest for 50 years unemployment in the UK. However, the new job vacancies rose to 1.3 million in terms of that labour market, how we're going to fulfil all those jobs, trying to reduce the inflation across the various job market sectors there.
I think what's key there is ensuring everyone is in employment is fundamental when you've got increased living costs and energy costs. At the same time, there needs to be real wage growth within those jobs and key sectors to manage and consolidate the inflationary pressures that we're seeing at the moment. So the balance of not just there being jobs available, but highly paid jobs or increased wage jobs for certain sectors and specialist areas to be able to cope and manage with the increased living costs.
Yeah, thanks, Rob. The Office of National Statistics have reported that without excluding bonuses from people's salaries, that the real wage growth has actually reduced in the last 12 months. It won't be a sort of big surprise for people to hear that when you calculate inflation. At the same time, people are moving jobs more than ever as well, mainly driven through resignations rather than any dismissals, with people seeking those salary increases which can't always be obtained in their sort of current roles. So, Rob, a very constrained labour market as we currently find things. Also, pressures on various sectors, food prices going up, and also the fuel prices surging, also almost at £2 a litre for diesel in some filling stations. So again, cost rises across the board as we're seeing it in the current economy. I think that's one section which we've addressed, but also Rob wanted to talk about the mortgage market as we find it at present. And a lot of UK banks are pulling deals at short notice from the market as they just adapt. So obviously interest rate rises, they have to come up with new products. There is also some affordability criteria some of the lenders have been looking at, and some of them have made some amendments, Rob, in the way that they're offering loans to their clients.
I think this is one of the most interesting spaces currently in the finance, lending and property space. I've been inundated in the last week with questions, calls, meetings, discussions around what is the current hot topic and the driving force, especially in the residential space over the last 18 months. And it's a really key moment in the market and the financial markets as well, with the Bank of England raising interest rates and suddenly major banks pulling all of their product and realigning their pricing model. And are they building in another 2 or 3 interest rate increases in the current pricing? Are they overestimating the effect of those interest rate increases? So is pricing slightly skewed currently because the lenders don't want to have the cheapest product? Everyone's rushing into refinance. I've been telling all the lenders we work with in every update call that we've had with all of them over the last few weeks, it's a refinance market as people chase the best deal that they can get currently to lock in for as long as they can, on the assumption that interest rates are only going up and the mortgage product and pricing is only going up. Now, what has that meant? It's meant the banks can't process and manage those applications as quickly as they could previously. That's been pushed out. It's delaying the whole sales process, to which we've seen now with average sale previously from interest offer to completion could have been 2 to 3 months. That's probably now pushing out to 3 or 4 months. And it makes the seller more anxious and the purchaser more nervous, driving more cash transactions. So if you're in a cash position, it's always a position of strength. But now, with that uncertainty and such volatility in the mortgage market, even stronger the cash buyer will be the key one if someone wants to exit. And people are thinking maybe that the market is quite heated or has possibly reached a high point, which is pushing more people to exit, thus creating activity. So it's such an interesting moment in the residential space, which is fascinating to us, and obviously we're at the forefront of that market, seeing all of those transactions on a daily basis. James?
Yeah, thanks, Rob. And just in terms of the mortgage applications, from what we understand, it's normally about a sort of 2 working day period where you hear your response from the lender in terms of your acceptance onto that particular mortgage, is an agreement in principle, the AIP. However, with some of the changing affordability criteria, and obviously banks being particularly busy at this point in time, flooded with applications, this is now taking between 1 to 2 weeks rather than 2 working days previously. And this is all at a time, a very competitive time in the market, Rob, when people are striving to get the best deal out there and try and lock in those mortgage rates, get their AIP locked in so they can then transact or refinance on a property.
Yeah, again, just to repeat, it's a fascinating space. It's what's going to drive the market over the next 3 to 6 months. And it's moving so quickly, and product and pricing is moving so fast that ultimately we just got to keep reporting, keep watching, keep sharing with you, and seeing how such movements affect pricing in the residential space.
Yeah, thanks, Rob. Just to give some of the listeners, viewers, a bit of information on that in terms of some of these affordability changes. It's all to do with the obviously the minimum salary for certain lenders, such as Nationwide. This has been raised, depending whether you're a single applicant, it is raised from in the region of 31,000 to 37,000 annual income. If you're a couple having a co-mortgage, the minimum earnings have also gone up there, which has also affected the multipliers. Some of their mortgage products previously at 4.75 LTV on the multiplier. This is now at 4.49, so that's just coming a little bit in terms of their affordability criteria there. And it's a story across the board, Rob. A lot of them are just tweaking these earnings ratio, LTV, what the multiplier is in terms of other affordability, and just stress testing in terms of if interest rates were to rise further, will the applicants be able to afford up to 2 to 3 percentage increase on the base rate. So lots of considerations from the banks, and they're just replicating that in the deals and mortgages which they're bringing to the market.
I think when you've got virtual 0% rates historically from the Bank of England that we've seen, the underlying concern across the market from an affordability perspective is what would happen if they increase by 1%, 2%, 3%. And we've seen that first percent increase over the most recent period, and it has the lenders scrambling. And what is interesting, I think, when the first initial rate change happened, you didn't see that reflected in the mortgage product. But now there's been multiple interest rate increases, and suddenly it's now having an impact on the product, along with the inflationary market conditions, which has affected the modelling of lending. Thus, all the areas in terms of those earnings ratios and affordability modelling has an impact. The flip side, James, is that ultimately there's a lot of money out there that needs to be lent, and if you go too far one way, then that will lead to more competitive lending. So it's a bit cat and mouse at the moment. A year ago, we saw ultra competitive lending, the 0.99 introductory offer. Now it's gone the other way. And depending on what happens with Bank of England fiscal policy, we'll see where it goes.
Yeah, I mean, obviously, it's those which are on the variable rate mortgages and the tracker mortgages at present who will be affected by some of these changes. Those that bought in the 2021 last year and had 2-year, 5-year fixed mortgages, they'll obviously be able to ride this for the duration of their fixed term mortgage, and then when they come to refinance, no crystal balls, but they'll have to assess what the market is and what the base rate is at that particular time. But obviously current consumers in the refinance market are slightly constrained in terms of the deals out there, affordability, a bit more sort of red tape in terms of what the lenders are, their criteria and lending policy.
Brilliant. Thanks, James. Anything else this week?
Just finally, actually, Rob, sorry, the Elizabeth line is obviously opening on the 24th of May, so next week. So obviously that's quite a big change. It's sort of linking a lot of those commuter belt areas to central London. I know the Queen was there earlier this week, just taking a look at sort of not quite the official opening yet, but 24th of May. So no doubt we'll be sort of catching that out sort of east or west London from next week onwards.
I've also had a look at that, James, and I was at Tottenham Court Road Station this week and looking at the preparations and the work, and maybe we'll head down there when it opens, James, and maybe have a photo and celebrate the welcoming of that new line.
Definitely.
Thanks, everyone. Inundated with questions and messages, which is brilliant. It's what we're here for. We're hopefully providing you with everything you want, anything you need, please let us know. Great audiences, great engagement, everything's great on the socials. Please keep downloading the podcasts, listening to it on your walks on a Saturday morning, or your drive or commute to the work if you're still going to the office. And anything else you want from the show, let us know, and we're here to provide it and give you great intel, data and knowledge on a weekly basis of everything that we see that's happening in property finance and super prime UK. But thanks for your amazing support, really appreciative, and enjoy the sun. It's going to be a semi-heat wave this week, so enjoy the good weather, and everyone take care. Thank you.
Thanks, Rob. Thanks very much, everyone.